as we mentioned, they're up in pre-market activity, but you see what happened yesterday. They were green in the beginning. They ended deeply in the red. David Nicholas joins me now. David, what happened yesterday?
Yeah, it was a mess. I mean, look, going to this year, it was services over stuff. And so what we saw all the retail numbers come out this week. It was pretty ugly, right? Macy's same-store sales down 7% year over year. Kohl's down. Home Depot. Abercrombie & Fitch was up 13%. I don't know who's buying Abercrombie. So that was one bright spot. But you had the retail sales number. And then we're in a market now that is not a buy the dip. It's a sell the rip. So we saw NVIDIA had a huge surge. We saw sellers come in. Yeah. So I think there's this uncertainty about where rates are going. If you saw what happened with rates, we're going to see Jerome Powell speak today. That'll have some impact there.
Well, there's also uncertainty about the economy itself. And Jim Bullard, one of the Fed officials, came in yesterday and suggested that, in fact, the economy might be strong enough. He didn't specifically say for a rate hike, but that's, That's what a lot of investors were thinking. Is that why it ended so much in the red?
I think so. And if you remember Jackson Hole last year, what did Jerome Powell said? He said there will be pain. Well, here we are. We're a year later. Where's the pain? You have unemployment rate that's still at 50-year lows. You have the Atlanta GDP outlet cast for third quarter at 5.8% economic growth. So this economy is strong, which is why I think yields are heading higher for bonds. That's going to give stocks competition, which is why on our bond fund, FIX, we're staying short-term. Short-term 6-month maturities are less, because if bond yields are going higher, that's pretty problematic for stocks.
And what kind of bonds? I mean, just a treasury. I mean, you get a 1-year treasury for well over 5% right now.
That's right. The 6-month treasury is yielding 5.5%. What we're doing is we're doing a little options overlay. So we're actually getting 6.5% with 99% in treasury. So you get a little better juice compared to what you would normally do.
What's the risk
there? 99% of the portfolio is backed up in treasuries. So it's built for capital preservation. So if you can beat the treasury market by 1%, that's not a bad deal.
So what happens if there is another rate hike? I mean, is that you already have mortgages, 30-year mortgage at 7.25% right now. I mean, if that goes, then the housing market is essentially frozen.
You're exactly right. And I think the biggest issue is going to be for banks. Regional banks could not absorb more rate hikes. I mean, I think you're going to see trouble. The Fed bailed them out in March. I don't know if the appetite's there to do it again. So I think if we continue to see rate hikes, mortgage applications are already down 30%. Same home sales are down over 20% year over year. It's not going to get prettier. But look, we may need it. The thing that can slow this economy is probably going to be continued rate hikes. So I would not put that off the table.
Now, did I just hear you suggest that the banking crisis is not over for the smaller banks?
It's not over. If you look at the balance sheets of these banks, they are so sensitive to interest rate rises. Another 2 hikes for interest rates, I think that could be pretty trouble for regional banks. And those are those systemic risks that are hard to diversify against. And once they start, it's kind of like a domino effect throughout the economy.
And I talk about the frozen housing market. There is also a frozen lending market for small businesses right now, partly because their old bankers, the smaller banks, are having such trouble, right?
That's exactly right. But with all of this negative, it's amazing how resilient the American economy is. I mean, in spite of what's coming out of Washington, the economy's still been growing. So it's pretty powerful, but I think that's why there may be more pain ahead to slow this economy.
Great points, David. Thank you very much. Good to see you.